Hey guys, welcome to the podcast. Today is October 3rd. The stock market is closed for business, and you're starting to see a little bit of fear pickup, aren't we, in this government shutdown, potential default, all of these things. And, up until now, the stock market seemed pretty calm, and still for the most part is. So let's run over the numbers first, and then we'll kind of get to really what it all means and how we're positioned at least. The Dow Jones down about 140 points, down about 1%, didn't close on its lows of the day. The S&P 500 down about 15, back under 1,700. It's at 1678, down about 0.9%. You had interest rates didn't really go down, and we'll talk about that in a second. Gold was up just a little bit. The dollar was stronger. Oil was down, and you had kind of the riskier stuff down, such as the Russell 2000, the NASDAQ mid-caps, and they kind of led the way down. Mid-caps actually held up, but Russell 2000, NASDAQ were the worst of the bunch. And, of course, volatility was up, and we'll get to that as well. So if you take a look at the 5-minute picture today, you'll notice that we did sell off, and then we bounced, but we didn't get the continuation that bulls were hoping for, and it certainly didn't look like real intensity. And so that may be a concern short term. But getting back to the daily picture, we're in this pattern right now, and we'll get to kind of why things are moving the way they are in just a minute. But we have this pattern of this zig and zag and zig and zag. So again, what do we expect? We expect, where did I finish, zag or zig? Anyways, we're going to have whatever means the arrow going up, either a zig or a zag coming soon. Is it going to start from here, or is it up here? I don't know. We don't know. But what we need to do is start figuring out eventually when that happens, how are we going to be positioned? And what happens if it doesn't happen sooner than later? And this government shutdown that's happening, let's run through that first, because many of you, I know, were probably worried about what would happen to the stock market on Monday if they didn't come to some type of resolution Sunday night. And they didn't. And Monday opened up, the stock market had a pretty good day. Pretty much everything on the screen was green that day. A lot of people were fooled by that, because they said this doesn't make any sense. I would have thought the market would have been down. Then we come down the next few days. Obamacare kicks in. We've got the shutdowns in place, and we're still not seeing any progress there. Negotiations continue to break down. And so the stock market the last few days has been lethargic. Now, since this peak, which was, right around the 18th or 19th of September, this downdraft we've seen has not been on excessive volume. It has not been real intense fear-based. It's been more of a methodical sell-off, very similar to what we've seen most of this year. And remember, this year we have not seen a lot of fear. Anytime fear has picked up, what has happened? Bulls have come in and bought that fear. I don't think this will be any different, to be honest with you. And, what's happened is I think investors are looking back over the last few years and said, you know what? We've seen this before, haven't we? We've seen this stalemate that doesn't look like it's going to get resolved. Nobody's willing to give. And what happens? The stock market starts to get a little dicey. They get something done, and business as usual. And so we're not going to put our retirement at risk and our capital at risk just betting on the fact that, well, they'll resolve it. But the thing is, we have to look at how investors are reacting right now, and they're not panicky. And so we shouldn't be panicky either. But what's key so far has been this 100-day moving average for most of this year. So that's your kind of line in the sand. We may go a little bit below it as this drags on, but I think, again, right now you got to look at this as kind of your channel. And there's no reason why it shouldn't bounce somewhere in the, let's call it 1660 area. Not to get too specific, because, this thing could go on for a little bit longer. But for us to default on the 17th of October, I don't think it's going to happen. Now let's go back to the government shutdown. We have had, over the last, since 1976, We've had 17 shutdowns. That may surprise some of you. Some of you may not have realized the government has shut down 17 times since 1976. Now, would you have thought the stock market would be up on average during that? Down? How many times would it have been up or down? The stock market has been down about 9 times out of the 17 and up about 8 times. Not about. It has been up 8 times and it's been down 9. And the average gain or loss has been under 1% of a loss. The biggest gain during any shutdown was less than 2%. The biggest loss was under 4%. So, you're not seeing, and by the way, the average number of days of a shutdown has been 6.5 days. So this is not something that typically drags on for months. It's not something that has had a major effect on the stock market. It just hasn't. Now, let's fast forward, because we know the stock market, has pretty much shrugged off the shutdown part. What is it focused on? Well, it's focused on this debt ceiling debate, which is coming up. That could cause what? Another downgrade of our AAA rating from other agencies. It could cause, a trickle-down effect, which not only affects the bond market, the stock market, but it also affects, eventually, the economy. The government being shut down for 5 or 6 days is not going to affect the economy. It is very expensive to shut parts of the government down. It's very expensive to start it back up again. I talked to somebody over the weekend who has been basically preparing the last 3 weeks. He spent most of his time preparing for a shutdown. That's what they've been doing in their office. He said it's labor intensive. It's a big deal. He's having to work even though he may not get paid. And then obviously if they come back in, it's going to be very expensive to start things back up again. So it's not just as easy as flipping a switch on or off. Okay, so you have that going on, but this debt ceiling, the closer we get, obviously the stock market is going to get volatile, and we've seen the volatility. Now let's look at the volatility index, the VIX they call it, and let's go back and what we've seen before. And again, as I've said before this year, until proven otherwise, you have to kind of go with what's worked this year. And what it is each one of these spikes in fear has been a buying opportunity. So when you get those spikes, those are temporary sell-offs, and you get a buying opportunity. And you can see over here on the left, this is how high the VIX got today, but you're not seeing things close at that high level. So some of the fear came off as the day went on. In fact, one of the other things that we need to be watching are interest rates. So let's take a look at TLT, which is the Treasury ETF, 20-year Treasury ETF. Now, we know it had a tremendous sell-off. Treasury bonds are still down about 10% this year. So if you own government bonds, you're down about 10% this year. If you look at this, it looks like almost like Apple did earlier in the year, where we had it straight down, and now you're starting to see these things kind of at least stabilize and kind of move sideways. Some of these moving averages are starting to straighten out a little bit. But if this was a really intense fear-based sell-off, what would we see? We would see this thing starting to really race up. We're not seeing that right now. In fact, let me kind of zoom in on a 5-minute picture here of TLT. And what you'll notice is out of the gate, TLT is going up. That means people are buying bonds, right? They're selling stocks, buying bonds. And then what happens the rest of the day? Trickle, 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 closes on its lows of the day. That is not fear. Fear is Treasuries going straight up, okay? So a lot of people believe that this economy is strong enough to withstand, or should I say, it's going to cause interest rates to go higher. Now let's take a look at interest rates, so the opposite of this. And you'll notice that 3% was a ceiling temporarily. And now what's happened is we've run up, we've come down, and we could be kind of stalling out here at the 100-day moving average of rates. And if we continue to get better economic numbers, this could certainly turn higher. It's not that I don't see interest rates potentially going higher. It's, are they going to go up at the rate that they had been going up from May to early September? Are they going to continue that trajectory? And the answer is no. If they continued that way, we would go into recession. The economy can't withstand that type of move that fast. What it can withstand is a methodical going up, moving sideways for a while, trickling up a little bit, moving sideways, As the data gets better, we want interest rates to go up naturally. Okay, that's what we want. What we don't want is interest rates going up because there's a bunch of inflation. The Fed's obviously still worried about deflation, not inflation, which is why they didn't do their tapering. So interest rates may have run their course on the downside. So what we need to start looking at is things like the TBTs, which is the short treasury. That was a tremendous trade up to here. Is it now a good entry point? Remember these stocks that run up and you go, boy, I missed it. They come back down and you say, well, I'll try to get it when it's down here. Well, it never comes down there, does it? So what happens is these things actually go up, they pause a little bit, maybe give back a third of their gains, and then they go off to the races again, or at least methodically move higher. So let's watch that, because that may be something that will be a good trade here. But again, over the next couple of weeks, if fear picks up, interest rates are going to go down, people are going to buy bonds. This is kind of a longer term play to look at TBT. And again, I have no position in that right now at all. So kind of back to the S&P here. I found it very interesting. If you notice, when do these crises end? It's when the stock market says, you better end it or we're going to keep going down, right? It's people get really panicky and start selling. Because that wasn't happening the last few days, I guarantee you, the president woke up a couple days ago and said, the government shut down and this market's going higher. This is not what I anticipated happening. Does he want the market to go down? I'm not saying that. I'm just saying that sometimes people think that will help their cause. We see a presser yesterday, today. I don't remember. The days kind of run together. But the president comes out and essentially says, investors need to be scared. They need to be scared of what's going on. And what happens? The stock market sells off. It's almost as if they want to talk the stock market down to push the hand of Republicans, Democrats, whoever, to come together and get this deal done. Because if the stock market's not going down, the politicians think, well, we've got time. Nobody's scared. Why should we cave? It's when the market starts going down and markets start to shut down and people aren't lending and credit starts to tighten up that these deals tend to get done. So we may see, by the time this is all said and done, one of these big, nasty washout days that sometimes we see to kind of end this, one of these 90% down days, a day like this where it goes way down but doesn't close at the low, and that was the reversal. We have this real nasty day right here. What happens? That was a low, and the market took off again. So could we see one more or two more or three more really bad days and get the fear really spiking up, and then it turns up again? Absolutely. There's a lot of people, smart people, that say we're absolutely not going to default, and it's just not going to happen. They're playing a game of chicken. It's sad. But look, bottom line is we know what happens when government shut down, and we've kind of seen this before. Fiscal cliff looked like a huge deal, and then it just, it went away. And so there's a something you have to separate. You have to separate the noise of the TV and the headlines and the scare tactics and the this, that, and the other with what makes stock markets go up and down. I did a television interview, which a lot of you may not have seen because you're not in San Antonio. I was hoping to post it online, but didn't get the clip of it. But basically, this is a chart I showed, and it's a lot of you that follow the blog, follow the podcast, have seen this before, and I update it, and it's one correlation in many. But our job is to find what makes the stock market go up, what is correlated with the stock market. And what you'll notice here is that in the blue is the S&P 500, the stock market, right? It goes all the way back to 2007. In the red is the jobless claims. It's the number that comes out every week. It came out this morning, and it's continued to fall. Now you're saying, well, if it's falling, why is it going up? It's because I've taken the line and I flipped it upside down. And you'll notice that basically what this means is when the red line's going up, less and less people are filing for unemployment. Now, again, there's a whole commentary on the quality of jobs, etc. You already know my feelings on that. We're not going to get into that. What does the stock market care about? It cares about this number. It cares about the fact that, regardless of what's wrong with this country, there are less people filing for unemployment every week. That is happening. And as long as that continues to happen, the stock market continues to go higher. Are there times that these things disconnect? Absolutely. Right? There are times when the summer of 11, during the debt crisis, that this goes down. Meanwhile, this is going up. So guess what happens? The stock market eventually catches back up. And, this number continues to rise. And by the way, this is a 10-week moving average, so it kind of smooths it out a little bit. But this number continues to rise. So again, that's just one thing we look at, but it's important. It's important because if this starts to roll over like it did back here and head down, then you've got some not short-term concerns, you've got some major concerns. So you don't completely abandon your plan just because they're on TV fighting about this stuff. But you methodically move around, you keep some cash on hand, you take advantage of things. There were stocks up today. There was plenty of stocks up today. You try to take advantage of those. You try to take some profits at times. Have some things that benefit from falling rates. Remember, nobody wanted interest rates, anything having to do with interest rates, a few weeks ago. And now everybody's been trying to flock to bonds. And it's happening. But neither one of those is correct or wrong. It's just you have to own a little bit of each of those at times and kind of weight those things. So they're going to resolve this, but again, the volatility could pick up a little bit in the short run. But we're at the point now, some of the indicators that I've created and watched, one of them right now is in the fear zone. And it's not a panic, but it's in the fear zone. And if we see the fear ease off a little bit, that's when we attack and we buy. We don't want to buy when fear's escalating, because you could be in the second inning of that escalation, we'll call it. You want to buy when the fear has already peaked and it is coming down and people are starting to calm down. That's when you want to buy. And it's still increasing at this point. So again, once it comes down, that's when we would attack. Right now, keep a little powder dry. Calmer heads prevail on the investing side, and let the yahoos try to work it out in Washington. I know it's an oxymoron, working it out, like they're really going to be able to do that, but they will come up with something. It's not what we want, but it's something that will be resolved. All right, guys, thank you for joining me here. Don't forget, twitter.com/Carl Eggers, eggerscapital.com for the money management website. Eggers Capital on there. You can find the Facebook page on there, iTunes, etc., etc. Have a wonderful day, and we'll talk to you soon.